Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
If you're like me, chances are you're not a big fan of paying taxes, especially too many taxes. And when you sell a multifamily property, the tax bill can be huge. And today, our special guest, Michael Velasco, is going to show us how to use 1031 exchanges to minimize our taxes legally. So, Michael, welcome to the show. Great to have you.
Great to be here, Dave. I'm really excited to talk about 1031 exchanges. And
well, you better be, because you got a whole company that's all about it, man.
That's all we do. All day, every day, all over the country. Yeah.
So, Michael, we've talked about 1031 exchanges on the show before, but not everybody hears every episode. So let's just start at the beginning. What the heck is it?
So here's the basics. 1031 exchange is part of the code, the IRS code. And in that section of the code, it offers the ability for investors to defer their taxes in trading real property for real property. So going from one piece of real property to another without paying taxes, and typically trading up or going to a different market, et cetera. And so the IRS said, well, we're going to defer these taxes. And the three taxes typically in the States are the long-term capital gains, right? IRS level, national level. Then you've got long-term capital gains in the specific state, depending on what state you're in. Like California, for example, they have ordinary income on long-term capital gains, which is an interesting thing. Yeah. So, and then there's something called depreciation recapture. As you depreciate the asset, whether you, and I know Dave talked about cost segregation before, is whether you cost seg it or you do a regular 27.5 or 39-year depreciation schedule, depending on the asset class, you're going to get depreciation recapture tax at 25%. So what we're doing when we do a 1031 exchange is we're saying, hey, we're going to take this property, sell it. We're going to buy another one in a specific time frame, which we'll get to in a second. And during that time, you're going to use a qualified intermediary like myself, and you're going to trade into the property, and we're going to completely defer the tax event that happens when we sell the relinquished property.
All right. So just to put it in simple forms, if I've got an apartment building and I sell it for $10 million today, instead of paying a big whack on my profits on that sale, I can take my profits. I can buy another property, ideally maybe bigger. So say I get into a $20 million property, don't have to pay any taxes on the first one yet. If I buy the new property using a 1031 exchange via somebody like yourself in a specific amount of time. Am I getting the gist there?
Exactly. And there's really, I think, 4 or 5 things when you're thinking about doing a 1031 exchange you should know. And these 4 or 5 things, as an investor, if you know this, you know more than 99% of investors are probably real estate agents. And the first is, it's got to be an investment property. It can't be a primary residence. There's a different exemption for that. Okay. So you can, as long as it's an investment property, you can 1031 exchange it, or for business use. So if you have a auto shop, for example, and you work in that, and that's your business, that's for business use. You can also 1031 exchange that real property section. So 1, investment property. 2, you have to buy equal or greater value. This is the one that gets people. Right. If we have a $10 million multifamily, we have to, regardless of what your realized gain is or your basis in the property, you have to buy equal or greater value. So we can take that $10 million and we have to buy at least $10 million in real estate. The IRS does not want us going backwards. So in our sales price, so equal or greater value. And that means you can buy one of greater value, or you can go down and buy 10 different $1 million assets in that case.
Okay. Yeah. So you can't go either way, as long as they are equal or exceed the original price.
Exactly. Yeah. The other is the same taxpayer rule. This one's kind of gets tricky, and I don't want to get in the weeds with this today, but just know that the seller of the property needs to be the buyer on the property, the same seller and buyer. And sometimes those could be partnerships, S corporations, C corporations, or just you and I in our personal name, right, Dave? We own it in our name or a disregarded entity. So the seller has to be the buyer on it. And then, of course, the time frames, 45 days to identify, 180 days to close. That's safe harbor for a 1031 exchange. 45 days from the date we close the relinquished property, 45 days to identify. And you're probably asking, well, how do you identify? It's just a simple form. We fill out what properties we identify. And then we have 180 days to close those the replacement
on one
property.
of those properties that we
On
identified.
at least one of those properties. Yeah, exactly. And so that's, if you know those things, you know probably more than 99% of real estate investors. So
Okay, I can see the pros to doing a 1031 exchange. It's not all, sunshine and roses with everything here, Michael. What are some of the downfalls to this? And I think I know the answer, but
yeah, the downfall, the biggest one is on a forward exchange. We'll get into 2 or 3 different types of exchanges. I want the listeners to know. The 45-day timeline is the tight one, right?
Yeah.
You're trying to find the right asset within 45 days. And that's really maybe the biggest downside. And if you don't find one or don't identify the one that you're going to close on, the exchange fails, or don't close on it within 180 days. The exchange fails and you're going to pay taxes just like you normally would.
Right.
So that's probably the rub. As this is what I've found, Dave, as the investor starts to acquire more and more of a portfolio and more net worth, they are more unlikely to do a forward exchange because of the 45-day period.
Right.
And we may be asking, the audience may be asking, well, what's the other option? The other option is we could do a reverse exchange, and that's the second type of exchange.
Okay.
So we can go and say, hey, we found a property, a replacement property. We can acquire that in a LLC. They're called title holders. But for the audience, just think of it as an LLC we're going to create. Exchangeable is going to create, and we're going to go on title temporarily until we sell the relinquished properties. And then we work backwards. And the 45-day changes to identifying the relinquished property instead of the replacement property. And so we just have to close those relinquished properties within 180 days and get reimbursed. And when I say reimbursed, if you're doing a reverse exchange, buying the replacement property first, right, you need capital in order to do that. You can get a loan, but typically these folks doing reverse exchange have some liquidity or access to liquidity to buy the replacement property prior to closing on the relinquished property, because we don't have the liquidity event, right, Dave? We don't have the event where we're getting a bunch of capital to go buy a replacement property. But the reverse allows you to take your time and sit back and find the right deal and know what you're going to close on before we close on the relinquished properties. So those are reverse exchanges.
Not only know what you're going to close on, but you actually buy it. Like you actually close it.
Yeah, exactly.
Okay. So if you got a bucket full of cash and you're not desperate to sell what you call the original property, the relinquished property, you find a really good deal, go ahead, buy that. But you already got in the back of your mind, you're going to sell a different one.
Yep.
Then buy it using this, what did you call it?
They're title holders. They're exchange accommodator title holders.
Yeah, so this is the reverse exchange, right? Reverse
exchange. It's a fancy name for an LLC.
So you buy it, and then you can go back and you can tell the government, okay, I'm going to sell this property. You identified. You got 45 days to identify it. Then you got 6 months to sell.
Exactly.
Okay.
Yeah. So the 45-day identification is not as big of a deal because you know what relinquished property you're going to sell, right?
Yeah.
For the most part. And then at the end of it, after we sell the relinquished, we take the LLC. Remember, we set up this LLC to hold title.
Yeah.
The sole member was exchangeable. All we do is flip the member inside the LLC. We don't change the title. The property stays in the LLC name, and we flip the member from exchangeable, no longer exchangeable. It's now the taxpayer. And that's how we consummate the final sale after we sell the relinquished property, which transfer the membership interest. Okay. And then boom, we have a good exchange, and the taxpayer now has it in their name.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
And I guess the worst case scenario under that situation would be if you're not able to sell the original property in 6 months, then what happens?
So that's a really great question, Dave. So we would never have an actual exchange happen, and we transfer the LLC back to the taxpayer at the end on day 181. We transfer the entity over to the taxpayer, and there's no taxable event because we didn't we didn't sell the relinquished property.
So now instead of one property, you got two properties.
Now you got two properties.
In which case, with the original property, you could do a normal forward exchange.
You can go back to it. Yeah. Dave, you're sounding like a pro here. Yeah, you could go back and do a forward exchange. There is something in that we use. It's called a non-safe harbor reverse exchange. On a reverse exchange only, there is case law, and the case law is Bartell versus Commissioner out of the state of Washington, very close to you, Dave. Mm-hmm. And in this case, the Bartell family held the QI held the property for 2 years. And so that the IRS disputed it. And basically the family took the IRS to court and said, hey, we think this is allowable. The family won. That was a Ninth Circuit ruling. And that case law has been used for reverse exchanges that take longer than 180 days to sell. It's outside safe harbor, but we use that case law where folks don't mind a little bit of risk tolerance. But generally speaking, that case was decided in 2016. For the last 10 years, the IRS that we know of has not really tried it again against the taxpayer. Yeah. Now, California is a little different, as you can expect, Dave. California, watch out. The franchise tax board doesn't necessarily agree, from what I hear.
Well, we won't get in the weeds there. So, from if I haven't missed something, we've covered two kinds of exchanges. What's the third one that you're talking about?
The third major one. There are some other ones, obscure ones, but the improvement exchange. And so, if we have a value add multifamily, let's say we sell a $10 million multifamily, and we find a great deal on a $8 million multifamily that needs value add, which, as a lot of your listeners probably love the value add play.
Yeah.
So we can go, okay, we've got a $2 million problem, right? Equal or greater value. And we have $2 million that's left over, but this property also needs $2 million worth of work. So we can sell the relinquished property and start a forward improvement exchange. So we sell the relinquished property. We have 10 million, 8 million of it we take and buy the replacement property. Yeah. And then the other 2 million we use to improve the property in that 180-day period. So
the improvements have to be done in 6 months.
To the extent of the exchange funds, yes. Yes. So if you really put 12 million in, but we only had, with the 10 million to meet for the equal or greater value, those 2 million need to be done. Yeah. In that scenario.
Okay. So it would work well if you got some big stuff to do quickly, but if you're waiting for normal turnover of apartments, that probably wouldn't work out that well in that scenario.
Yeah, exactly. So there has to be a little bit of a sweet spot. There is a way. On a reverse, you can do a non-safe harbor improvement exchange, which is really what the case was all about. And the QI can hold it, and we can do improvements and then get it fixed up, and then we sell the relinquished property. And those are pretty popular on bigger projects. But for the purposes of our example, that 2 million is in the account, and we're just cutting checks to contractors, over the 6-month period. And then at the end, now we have a fully improved $10 million property to be equal or greater value. We use the title holder, just like we did on the reverse exchange. We hold the property when we purchase it for 8 million in the LLC and do the repairs. And then once it's fully improved, then I can transfer it to the taxpayer, because the taxpayer can't own it till it's fully improved. And
so based on your experience, Michael, we've looked at 3 different options there. Which one is just like the bread and butter of what you guys do?
Forward exchanges make up probably 80% of exchanges.
Yeah.
Yeah. So you're selling one, you're buying another. And there's some other ways you can, as an investor, really help with the 45-day period. You can go get that replacement property under contract and just say, hey, we can't close. Subject to. Yeah. And put maybe some non-refundable earnest money. Say, hey, we're going to close on this, but I need a few months. I got to sell this relinquished property, just like we do normally. Dave, we got a contingency upon the sale, but we also don't want to blow the exchange. So maybe put some teeth behind it that we can close on this at a later date. And so a lot of clients do that, where they kind of finagle or do a longer close on the relinquished property, give you more time to identify. Because remember, the 45-day clock does not start until the close of escrow. So you can do a 60-day escrow, right? And then find.
So does it go 45 days, then 180 on top of the 45 days, or 180 total?
180 total. The 45 is part of the 180.
Part of the 180. Okay.
Yeah.
All right.
which is a really, so you can manipulate this within the code as long as you haven't closed on the relinquished property,
So in your experience, you've been doing this for how long, Michael, at this point?
So this is my 6th year as a QI. Prior to this, Dave, I owned an accounting firm for 4 or 5 years before I sold it. So that I got my tax background. I was a broker for 20 some years. And then, of course, since then, I've got my CES designation, which is kind of like a CPA for an accountant. CES is for QIs. I own the firm here. We run a very concierge type of shop. And so I stay very involved, as you can tell just from our conversation. The nuances of this are pretty vast. And so I've got a great staff that helps with paperwork, but I really like the forward facing with the clients because I want them to stay out of trouble.
Well, that's what the next question I was going to ask you, Michael. So if you could wave the magic wand, at what point should a prospective client actually be talking to you? Like I'm sure you've seen it where they've sold a property, now they're scrambling trying to figure out what to do, or they've got their properties under contract or something. Now they're scrambling what to do. Yeah. So what are some of the big, like if you could wave the magic wand, when should somebody be talking with you guys?
Yeah, and I'll tell you what the worst call I get is Monday morning. I get a call and the client goes, "Hey, we just closed on the relinquished property," and I said, or just sold the relinquished property. And I said, when you say sold, do you mean closed or under contract? Because if it's closed, we're done. The exchange has happened. So you have to be engaged before you close. You can't be under contract to engage with a QI, but you cannot sell the relinquished until you're engaged with a QI or the exchange is over. So your question, what is the best time to engage with a QI? Before you list that relinquished property is ideal. Because
I guess I'll ask one more question. What the hell does QI stand for?
Great question. Qualified intermediary.
Okay, there we go.
We're also called exchange officers. We're also called CESs, but the QI, because it just makes it easy to pronounce, I guess, more than anything.
But we get called high enough to know what QI stood for. So there you go.
Yeah. Well, most people don't. So qualified intermediary. And so back to the when should the clients contact the AQI, whether it's our company or another, is when you're listing. It's good to have a conversation. Say, hey, this is what I got, and so I'm going to ask all kinds of questions. Who's on title? Well, it's a trust. Okay, tell me about the trust. Or it's an LLC. Okay, tell me about the LLC. Is it on your personal tax return, or is it a partnership? So I'm digging through. I'm trying to keep the client out of potholes along the way, and then they get something on a contract and then we got a problem, some sort of issue that comes up. So I think, engage with a QI, and it doesn't even have to be a formal engagement. It could just be, hey, let's have a conversation on my website.
I'm thinking about selling my property. Yeah. There's going to be a big tax consequence. I'd want to minimize that. That in my mind, that's the best time to talk with one of you guys. When you're thinking about selling your property, just so you can get your ducks in the line, right?
Call to the CPA, a call to the QI. Sometimes that conversation happens via Zoom together. It happens a lot with my clients, especially as the complexities arise or something's really complex. I'll have, like this morning, I was on the phone with tax attorney, CPA, and the client and myself. And so they can get quite cumbersome in some cases. 90% of the exchanges will be pretty straightforward, but nonetheless, you should be having a conversation. Hey, this is what I'm doing, and kind of vet through the process, know what you're going to do, get coached up on, hey, this is how it works. And then it makes it easier on the client. They know what to expect. And, expectations are a lot in life. Like, what is your expectation? And that's usually when disappointment happens, when expectation meets reality. So I just try to get them really coached up on what they can expect. And, hey, this is what we're going to do and how we're going to do it. And then we just execute. But typically speaking, the exchanges go flawless. I mean, it's some of them go
but the earlier you start, the better. Well, this is great, Michael. So if people are listening to this and they want to reach out and connect with you and have a conversation, where should they go?
Website's the easiest way, 1031exchangeable.com. That's 1031exchangeable.com. You can click on a link there. There's a Calendly link right there. You can get right on my calendar. You can submit a form fill. There's 20 different YouTube videos on all kinds of topics on there too. So yeah, love to help you.
Michael, thanks very much. That was a very clear, concise explanation. I really appreciate that. I admire that you could explain it in very good everyday man speak versus CPA speak.
Yeah, layman's terms.
Yeah, layman's terms. That worked really well. So thanks very much for being on the show.
Yeah, appreciate it. Thanks, Dave.
All right, everybody, take care, and we will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.